Hey guys, today we're going to take a little time and work some problems related to a job order costing system. I'm going to keep the problems up here on the screen for a little bit, so you might need to come back in here and pause the video here from time to time to review the problem that's on the screen, and then we'll take a look at the solution for each of these. So in this first one, we can see that Gross Company purchased 72,000 units of raw materials at $8 per unit. And that was on the 8th, and on the 19th, raw materials were requisitioned for production. And we had 32,000 units for job for job 60, and 37,000 units for job 61. Okay, so let's journalize the entry to record the purchase and the requisition from the materials store. Okay, so we can see here, and we remember from the problem that 72,000 units were purchased at a cost of $8 per unit. So if we multiply those two guys together, we get $576,000. We're going to debit materials to show an increase in that asset. We're going to credit accounts payable to show an increase in that liability by $576,000. With respect to the requisition of materials for production, there was a total of 32,000 units that cost $7 a piece for job 60, and this amount related to job 61. When we multiply those and then add it all together, we're looking at a total of $520,000. So we need to show a reduction in materials and show an increase in work in process. Remember, work in process is where the materials are after they've been requisitioned and before they are finished. In addition to direct materials, it's going to require direct labor to be applied to these raw materials in order to convert them into their finished product. So we can see during February there was 15,000 hours and with respect to job 60, and 18,000 hours for job 61. There's different rates for both of those. Let's take a look at the solution for this problem. So you can see here we simply multiply number of hours times the hourly rate for each of these different jobs. We add the totals together, and once again here we're going to increase our work in process by $837,000. We know here that based on the absorption costing system that we're using, all these costs are going to be counted in work in process, which is going to stay on the balance sheet as an asset until the finished goods are actually sold, and at that point it's going to become cost of goods sold. The offset, as you can see here, is going to go to wages payable, which is a liability, and that'll stay on the books until we actually pay those employees. We can see here a little information about the factory overhead costs that are incurred. These are the actual factory overhead costs. So let's see here, during February there were indirect materials of $34,000, $81,000 of indirect labor, utilities of $10,000, and factory depreciation of $61,000. So let's see what we would do in order to record this factory overhead that was actually incurred. So as you can see here, the total of all these, we had the materials at $34,000, the wages at $81,000, the utilities payable at $10,000, and the accumulated depreciation at $61,000. All of those were amounts that were actually incurred by us, and we're going to debit factory overhead. So remember, we're going to have this factory overhead here that was the actual amount, and when we're determining if we have an amount that was over or under applied, we're going to have on the left hand side our actual, and on our right hand side the applied. At this point now we're going to have to apply the factory overhead, and keep in mind that the company's not necessarily going to know how much it's going to have with respect to overhead along the way, and so it's necessary to come up with an estimate to apply to each job instead of waiting until the very end of the year to know what numbers are actually going to pan out. The solution to that problem is to apply the factory overhead. Let's take a look at a couple slides here really quickly. Okay, here, so we can see what a predetermined overhead rate is, and it's something we use to assign overhead costs to various jobs. Okay, this is not, like I mentioned before, the actual amount of overhead used, but it's rather an estimate. Now, at the very end of the accounting period, once we know what these actual charges are going to be, we're going to compare the two and make the amount that we applied equal to what the actual was. If you want to pause the screen here, once again, here's some reasons why a predetermined overhead rate is necessary. So manufacturing overhead is applied to jobs using an allocation base, such as direct labor hours, direct labor dollars, or machine hours. Okay? So now that we know how we're going to divvy out overhead, the next question is how much is going to be divvied out. So before the accounting period begins, we're going to need to set some of these estimates. So the predetermined overhead rate used to apply overhead to jobs is determined before the period begins. And you can see here we're going to, in the numerator, have the estimated total manufacturing overhead for the upcoming period divided by the estimated total units in the allocation base for the upcoming period. Okay, so at the bottom here it says ideally the allocation base should be a cost driver, that is, it causes the overhead to be incurred. So as we're working on a job here, we're going to multiply the predetermined overhead rate by the actual amount of the activity. So remember that predetermined overhead is based on estimates of the period, and while we're going through, we're going to multiply it by the actual amount of the allocation based upon the actual level of the activity. So we're going to multiply that estimate of the predetermined overhead rate by the actual amount. And as you can see down here at the bottom, overhead is most commonly applied at the end of a job, but may be applied periodically while work is being done as well. So as you can see here, we're estimating overhead cost of $2,200,000 for the year, and we think that we're going to incur direct labor hours of about 400,000. So we're going to use this number in order to prepare the predetermined overhead rate and then apply it to the two jobs. So you can see our predetermined overhead rate in this scenario here is based on the estimated number that we're going to have for our cost and the estimated number of the direct labor hours that it's going to take for all of the different jobs in the upcoming period. So we get a figure of $5.50. So job 60 used 15,000 hours of direct labor, so we're going to multiply that. We're going to apply $82,500 of overhead to this, and 18,000 hours were needed for job 61, so we're going to multiply that by $5.50, and that's going to give us $99,000. We add those two together, and we're going to debit work in process. This is going to be added to the work in process, and remember that's going to be an asset until we actually sell these items. Once they're finished, they become finished goods and we sell them, and then eventually we're going to finally get to write those off as cost of goods sold. Might be more than a year, 2 years, 3 years before the item's actually sold, and only at that point can we write it off as an expense. So you can see here that that's going to be debited there. We're going to credit factory overhead for $181,500. We're going to need to compare the factory overhead that was applied with the factory overhead that actually was incurred throughout the year. And if there's a difference, we're going to need to take care of that as well. Okay, so we can see here that the actual amount of overhead that we incurred was $186,000. And based on the direct labor hours, we have $181,500 that was applied. So this is based on the estimates here, isn't it? So this is what we actually incurred and this is what we applied. So right now we can see that we had $4,500 more dollars than what we actually applied. So we're going to need to take care of that right now. So take a look here. Just a second. You can pause the slide here if you would like. So in order to make this balance equal 0, we're going to need to add $4,500 to this side, aren't we? And you can see here this is the journal entry that we would make to make the actual equal the amount that we had applied via our estimates. Okay, so we're going to increase our cost of goods sold and we're going to decrease our work in process by that $4,500. Let's assume for a second, since the problem stops here and it doesn't really ask us to make these two journal entries, let's just pretend that the problem said that $3,500,000 worth of work in process is actually finished. So this is what an entry would look like to take the $3,500,000 and move it from work in process. So we're going to reduce that and we're going to increase this asset here, finished goods. Okay? Now keep in mind, I just made these numbers here up to kind of show you what a journal entry would look like. So if you tried to calculate these, you wouldn't come up with these numbers here exactly likely. These are just ones I made up for purpose of illustration. Let's also assume here that we sold $2 million worth of these two jobs. So let's say we charged $2 million for them. And if it cost us, hopefully it cost us less to make it than it did to sell it, or than what we're charging the people for. So we're having some profit there. That's the goal of most businesses, isn't it? So if we sold $2 million, if that was a price tag on the jobs there that we finished, once they were sold and everything at the end, we're going to assume here, and I just made these numbers up here too, that let's say we had a cost of goods sold figure of $1,538,500. So this represents how much money we had tied up in that job. So we're going to need to reduce the finished goods. We're going to need to reduce that asset, and then we're going to have to show this coming through on the income statement as cost of goods sold. Like I said before, you might have a period of time of more than a year that goes by before we're going to be able to write this stuff off as an expense. And until then, it's going to stay on the balance sheet as an asset in finished goods. Work in process inventory is also an asset on the balance sheet, as well as raw materials. So once we place the materials into service, they become work in process. Once we finish those goods that are in work in process, they become finished goods. And once we ultimately sell them, we reduced finished goods, we increase cost of goods sold. I hope working these problems was helpful to you. Please let me know if you have any questions.